This is your Wall Street wake-up call after 3 straight weeks of gains in U.S. stocks. Is this rally sustainable? Let's bring in Josh Mahony, a market analyst with IG in London. So Josh, can we keep up the momentum this week?
Personally, I think that we're likely to see quite a lot of consolidation this week ahead of that ECB meeting. There's not really too much to get our teeth into from a fundamental standpoint, and I guess it's just a case of how much risk appetite do people want coming into a meeting where we saw exactly what happened in December. So there's a big threat that actually it could move in the complete opposite direction despite the fact that we could see some easing. So I do think we're likely to see less volatility this week and a little bit more indecision, a little bit more profit taking coming into play.
And do you expect the ECB to push those interest rates further into negative territory, those deposit rates?
I think that's pretty much a foregone conclusion. They know exactly what the risk is here if they underperform because, again, we saw what happened in December where they didn't necessarily manage to match market expectations. The deposit rate is one thing that I think is pretty much a foregone conclusion. The question mark is what they're going to do in terms of raising the amount of QE that they're doing on a monthly basis, perhaps changing what they're actually purchasing in terms of maybe buying in some corporate bonds. But I think it's going to be what happens around that. I think personally it's near enough a foregone conclusion about the deposit rate cut.
All right, let's shift and talk about oil prices. We've got Brent now near $40 a barrel. Do you think the markets will now start finally detaching from oil prices, from obsessing over the every cent of oil?
I think you've seen that quite a bit recently. Now, previously, of course, it was near enough in lockstep. Every time you saw the indices moving higher, you could flick the screen across to oil and it was doing exactly the same thing. You have seen recently that that correlation has departed a little bit. Of course, it's still going to influence certain markets. The FTSE 100 in particular always is going to have a decent sort of reaction to any sort of big move in oil prices because of the fact that it's heavily weighted in terms of commodity stocks. But yes, I think there is a little bit more of a divergence between the two. Nevertheless, we've seen both of them rally very heavily recently, so you can say that they are still highly correlated.
All right, now another big theme this year has been China. We had the Chinese government over the weekend come out and say they're expecting growth for 2016 between 6.5% and 7%. Is this realistic in your view?
I think it is realistic. Whether they're going to get it or not is another thing. But, it all depends on, do they continue to pump in stimulus? And also, I think that they're probably at a pretty much at their lowest ebb at the moment. I do think that they're probably going to improve quite a bit as the year goes on. What we've seen in terms of the markets today has actually been quite a massive response in terms of this and in terms of the expectations that China is going to do something. We've seen iron ore up 20%, so an absolutely huge rally in iron ore, and quite frankly that's quite devoid of what's happening from a fundamental standpoint. You look at what's happening in terms of Chinese data, it's not looking particularly great, but there is this expectation that the Chinese will continue to do more, and there is this expectation that actually it's likely they're going to improve from here on in. So I think, the markets are taking it in a fairly positive way, and I think that reflects the fact that many people do believe that this is relatively realistic.
All right, Josh Mahony, a market analyst with IG in London. Josh, thanks for joining us.
Thank you.
I'm Scott Gamm, and you're watching The Street.